My name's Dave Wilhelm. I'm a professor at Wake Technical Community College in Raleigh, North Carolina. I teach business courses, intro, entrepreneurship, and management classes. This video is one in a series that's designed to give my online students some of the same information as my seated students. I like to teach seated classes for the human interaction, and I like a few online classes because it makes everybody's schedule easier, but the online students may need a little extra information they can't get from the book or as much as I type. So this is cash flow basics, very, very basic. The topics we'll cover are a brief look at the financial statements, a high-level look at a cash flow statement, the activities that might be candidates for a cash flow statement, not all of which actually belong in the cash flow statement, and finally an example. This particular example, if you are in one of my classes, this particular example is the cash flow 1 problem, and if you looked at it and had a problem, this should help a whole lot. So 3 major financial statements: the balance sheet, the earnings statement, and the cash flow statement. Balance sheet looks at a point in time and compares what we got, what we owe, and the difference called owner's equity, or assets equals liabilities plus owner's equity. The next 2 statements, the earnings statement and the cash flow statements, look at a business over a period of time. Balance sheet, point in time; earnings statement, cash flow statement, period of time. Earnings statement is also known as a profit statement, a P&L, profit loss, or an income statement. Earnings statement, earnings, net earnings, earnings after taxes, that one down at the bottom, is equal to all the revenue minus all the expenses. The last one is the cash flow statement. For a small business, cash flow statement is probably, maybe the most important. You can keep a business if your balance sheet doesn't look good. You can survive a few periods with negative earnings, but if you don't have some cash on hand to pay things like employees, rent, you're in big trouble. Cash flow statement, the ending cash is equal to the beginning cash plus the receipts minus the disbursements. And notice the difference in terminology. For the earnings statement, we have revenue and expenses. For the cash flow statement, we have receipts and disbursements. Here it is. Once again, we have beginning cash. Now, whatever the cash was at the end of the previous period is now the beginning cash for this period. We add the cash receipts, we subtract the cash disbursements, and we've got the ending cash. That ending cash now is the beginning cash for the next period. Brief comment. When calculating the cash receipts, a common error seems to be to add in the beginning cash, but no, that's just the cash receipts for that period. Here's a basic cash flow template, and I gotta stress, this is really basic. Any business of any size at all is probably going to categorize their cash flows into investment cash flows, financing cash flows, marketing cash flows, various categories. This is just an example, so we will group everything together. If it's a brand new business, we'll start out in January. with 0, if it's an ongoing business, January will start with the previous December's ending cash. So here's January's beginning cash. We have some receipts, and those receipts we will add together to get total receipts. We also have some disbursements. We'll sum those together to get total disbursements. Okay, next, add the beginning cash to the beginning cash, add total receipts, subtract total disbursements, and we've got ending cash. And that's what the example is going to show. So, the activities that might happen in a business are the owner invests some money. He might draw from a line of credit or repay some of the principal on a line of credit, going to have to pay interest on the line of credit. All three of those items do show up on the cash flow statement. They all involve cash. Our business person can also hire and employ a lawyer, and at some point in time they're going to pay the employee or the lawyer. The hiring does not affect cash flow. Paying, that affects cash flow because we're paying. We can receive a utilities bill and we can pay a utilities bill. By now you've probably guessed that receiving a bill doesn't affect cash flow, paying it does. We've all probably got a little stack of bills sitting somewhere that have not affected our cash flow yet, but will have to pretty soon. So, yep, receiving, no effect, paying, yes. Getting supplies and delivering orders, we can place an order to our supplier, we receive the material, we receive the bill, and finally we pay the bill. And those first three things do not affect cash flow. Paying the bill does. Similarly, from our customers, we may receive an order, we'll ship the material, we'll send them a bill, and eventually we will receive payment. And just like our supplier side, our customer side, first three do not affect cash, the last one does. Depending on what sort of size screen you're viewing this on, you may not be able to see this, but these are the January activities from the Cash Flow 1 homework problem. And of these activities, only the ones with the arrows actually affect cash flow. So the owner invests in the business, pay Chapter S filing fee, pay deposit on utilities, pay lawyer's bill, pay office furniture bill, pay part-time employee. It's sort of a key word in there that says pay. And the cash flow statement is going to look something like this at the end of January. Owner investment, total receipts are $32,250 because all we have is the owner investment. Well, when it does start at 0, this is a brand new business. Seem to have a lot of disbursements and there are startup costs involved. So, lawyer, patent attorney, office furniture, salaries, utilities, Chapter S filing fee, total disbursements are $10,751. So the ending cash is going to be the beginning cash plus total receipts minus total disbursements, and that's going to be our ending cash of $21,499. February activities, pay utility bills, pay bill from supplier, draw from line of credit. That means we're pulling some cash in from the bank. Pay part-time employee and pay interest to the bank. They want some interest from that line of credit. And after February, our cash flow statement looks like this. Beginning cash plus total receipts. And total receipts consists entirely of drawing on that line of credit. More disbursements. So the ending cash is $21,499 plus $64.50 minus $24,989. So we've got $29.60 left over. There are two types of financial statements as far as time is concerned. One is an historical statement, what has happened. The other is a pro forma or projected statement looking into the future. Notice that we drew $64.50 from our line of credit, and our ending cash is $29.60. Without that line of credit, we'd be in negative cash land, and that's a really, really bad place to be. So some financial person at the company was doing a projected cash flow statement, said, whoa, we're out of cash, and got some from the bank so that the ending cash is positive. March has a lot of activities. We have two sheets of activities for March. Pay, utility bills, receive payment for customer order finally. Pay patent filing fee, receive payment for customer order, great. Pay bill from supplier, receive payment for customer order, receive payment for customer order, pay part-time employee, and pay interest to the bank. And after this month, our cash flow statement through the end of March looks like this. $29.60 plus $29,885 minus $29,373, so we got $3,472 left at the end of March. One thing this doesn't really explicitly show, but there's something called the cash-to-cash cycle. We started with around $32,000, and now we're at $34,772. But we've got a lot of bills outstanding there to those customers. So by the end of June, if you're actually one of my students who's going to do this problem for homework, things look a lot better by the end of June because we're making a profit and that cash-to-cash cycle is no longer hurting us so much. My name is Dave Wilhelm. I hope you've enjoyed this video on very, very basic cash flow. If you have any questions or comments, please feel free to email me.